Hello and welcome. My name's Steve Lambeth. I'm a portfolio manager and investment analyst at Climb. And this week on The View, I'm going to fill in and give Paul Zui a well-deserved break. We'll change it up and we'll have just a bit of a chat about recent developments in particularly share markets. So we'll talk about what's happened over the month of November, a bit about what the broader calendar year has looked like, and then just share a couple of insights on some of the goings on that might have something to say about the way forward in 2025. So we'll just start with a quick overview of the month of November. It was a solid month for equity markets, as you can see, and by and large, the US were a strong lead. They both increased in terms of the S&P 500 and NASDAQ up about 6%. And the common thread there was obviously the Trump presidency, where the Republican Party has gained control of both the presidency and Congress. Now, as we know, some of Trump's proposed policies would have perhaps negative consequences, such as in the areas of trade and growth, but it seems that US markets are celebrating and embracing plans for reductions in corporate taxes and also to reduce regulation. The buoyancy in the US did seem to rub off on the Australian market. You can see on the far left, our Aussie market increased a bit over 3% for November. And we also had a bit of help perhaps from bond yields. The 10 years softened a little. And also because of the outcomes in the US, we've seen this US dollar remain strong. And in other words, the A dollar has been a bit softer. And that's obviously helped our market to the extent that many companies have a large presence overseas, including the US. By sector, it was a very strong month for tech, and it probably won't surprise you that tech was strong in the context of just mentioning the US, where tech is a material sector. About 35% of the S&P 500 is comprised technology. That's not the case for our market. It's a small sector, but it's worth calling out because it did have a strong month. It was up 10% and led all other sectors. But interestingly, it was a sector that moved not just on sentiment and pure valuation. It did feature earnings in all things. Two companies, both Xero and Technology One, reported in the month of November and delivered strong earnings with a strong outlook. Elsewhere, it's just worth calling out, banks have continued to remain strong. CBA increased 11%. It actually touched $160 at one point. It closed at $159. So an 11% increase in just a month is quite extraordinary. And we'll have a chat about CBA again in a moment. And elsewhere, the utility sector was up. That was mainly driven by Origin. In consumer discretionary, we had some of the larger names perform strongly. And also, finally, the laggard sectors have continued to be laggards, being resources and energy. And so there's been quite a retracement from those two sectors in the aftermath of the late September China stimulus. So what's happened more broadly from a longer dated perspective? I've just chosen to update the returns that have been delivered at a total return level. So this is now price and dividend. And you can see over the calendar year to date, this is as of 30 November, share markets have, in the blue columns there, shown very strong performance calendar year to date. And given the good start to December, it would seem we are looking at this kind of backdrop for how we'll rule off the 2024 calendar year. The simple call out is across all of the markets shown here: Australia, the US, the UK. I've also included Japan and Hong Kong. In each of those instances, we've had a level of performance that is well above historical averages. And if I just opened up further, it's not easy to get data that goes back a long way for a lot of markets. However, the US S&P 500 is one, fortunately, where there's now almost a 100-year history of data available for this market. So I just downloaded the data to show you a histogram of returns to bring curiosity to what is a reasonable annual expectation. Well, as you can see in this histogram, there is much diversity. and dispersion. And what is on average has been a return of about 8% per annum versus what this year might be a return towards 30%, does sit within the envelope of a one standard deviation outcome. In other words, the annual standard deviation of the S&P 500 is about 19%. So given the average is about 8, this type of deviation takes us to the upper end, and at the lower end, you would be experiencing a negative return. So it is certainly an outcome that's looking to be at the upper end. But as you can see in the dark shaded column there, that's a reference to there having been 13 individual calendar years where the S&P has risen between 25 and 30%. And that's what this year, 2024, is shaping up to look like as well. And what about other asset classes? Well, more broadly, in mentioning equities, it's worth just noting as well, it has been seen elsewhere. I've just included a picture of Australian real estate investment trusts and global REITs as well. So there has been a better year seen across more than just the equity asset classes, although it is worth noting bonds, both Australian bonds and global bonds, have been relatively anemic this year, and that reflects what it means for bond yields to sustain themselves and not declined, notwithstanding there is evidence that policy reductions, interest rate reductions are underway. There was one asset class I didn't mention on the previous slide, and if we could call it an asset class, as many do, it's Bitcoin. And Bitcoin is worth a short mention, I think, not so much because it's something we can discuss by way of fundamentals, but more something we can discuss by way of what it means for it to represent, say something about the state of sentiment and the state of confidence going on in all manner of financial markets. Bitcoin, since Trump had his victory, is up 40 odd percent, from 70 odd thousand to now 100,000. Everyone knows that there's only a small percentage of coins yet to be mined. It therefore leads to the observation that it is clearly a case of demand exceeds availability. But that arguably applies to other asset classes or assets such as gold. And gold has not participated in any shape or form like this. So that's a little bit of an anomaly that I would call out. But I would instead be inclined just to say it is evidence to some extent that markets are quite exuberant at the moment. And maybe leading to the next slide, another way to demonstrate that is to show you the volatility index from the CBOE. So this is just out of trading economics and the full history going back to 1990 of the US VIX, or if you like, the fear index. Depressed states such as today is a representation of extremely low volatility that's being priced into the market, and arguably therefore a degree of complacency. The large spikes you can see that have happened over the years represent either geopolitical developments. The single biggest spike shown is the GFC, and then we had the COVID period. Crisis is normal, as our founder John Abernathy would say, but it is worth nonetheless pointing out that we currently are observing equity markets factoring in very little volatility, when volatility typically takes a moment to rear its head from time to time. So beyond just the price action, to what extent can we observe whether the price action that's been very strong this year is validated by earnings? And the message here on this slide shows that it's somewhat mixed. If we look just at the US markets, again, they are the big markets on a global stage, so they are worth focusing on. On the blue columns there, I've shown the earnings change over the calendar year to 30 November. So that's 12-month forward earnings and how it's been revised and how it's progressed as of the 30th of November against the orange columns, which is the price change. And you can see there that for both the US, S&P 500 and NASDAQ, those strong performances are validated somewhat by fairly healthy growth in earnings. You can also see there I've put the Euro StoxX in, I've put Japan in there. They're in the low single digits, but the point is there's a connectedness between the amount of price change that's happened this calendar year to date against the amount of earnings change. And then on the far right, and I've decided to highlight this, the ASX 200 is a little bit of an anomaly to the extent that we've had an 11% increase in price, and yet we've actually had a 1% reduction in the progress of the ASX 200's earnings. So let's talk a bit more about the backdrop of the US, and we will come back to Australia here. I mentioned the strong amount of performance reflected in a strong amount of growth. Well, it's also worth just noting, with this well-known driver of the US market being the Mag 7, it's worth just sharing that amount of growth in the overall S&P 500 and what contribution these 7 stocks have made. So if you just take that table in the top right and you scroll all the way down to the bottom, the S&P 500 started the year at about US 40,000 billion, i.e. $40 trillion. It's risen over 20% to get us to about a $51 odd billion value. This was a measure taken as of the 3rd of December. So it's risen in value by about $11 trillion. How much of that increase has come from the Mag 7? Well, you can see that list up the top there, running through alphabetically. The Mag 7 has increased in value from about 12 trillion to 17, so an increase of about 5 and a bit, which means the Mag 7 can be described as having driven close to half of the increase in the total market cap of the S&P 500. If you now look at the chart down the bottom, what you can see in that is that for the price increase that's been achieved collectively, or the value increase that's been achieved collectively across the Mag 7 of 40-odd%, it sits alongside an earnings increase of about 30%. So that's a justified picture, or you might say that's a picture of quality to the extent that there's been earnings increase associated with the price increase. Let's look at Australia. So if you thought the 7 stocks accounting for half of the increase in an entire market looks concentrated, let's have a look at Australia and do the same such calculation. And in this case, I've chosen to use the largest sector being the banking sector and ask, well, how much of the ASX 200's increase this calendar year can be explained by that amount of rise in value across the 4 major banks? And that's shown here in the top right table. You can see we started the year with the ASX valued at around about $2.3 trillion. It's increased about $250 billion to 2.5 odd trillion. And that compares to around about a $150 odd billion increase in the market cap of the 4 major banks, of which CBA represents half. You can see their increase of $77 billion odd dollars. So what that adds up to is a contribution from the banks of about 60% of the entire increase in the value of the ASX 200. Now, the question again is that validated in terms of earnings? And I've produced exactly the same chart as per the price slide to show how much have these banks increased in price and how does that compare to their increase in earnings. And you can see that there's been a 35% increase in the price of the banks, and that compares to a 7% increase in their earnings. And what does that mean? Well, what that simply means is that when we look at this type of performance, we associate it as being of much lower quality than what we have observed in the US market. This is just a follow-up from that prior comment to show that in the case of CBA, that's the one that's really stood out the most this year. CBA, alongside the other banks, historically has traded at a discount to the market. CBA has always commanded a premium versus its peer banks. But what's most interesting is that CBA has been producing circa $10 billion of profit for a prolonged period of time. It's a very mature, a very large and very well understood company. And what that simply means is that when you go to Visible Alpha or when you reach out to brokers and look at their estimates, which are all in the low single digits heading out into the future, you can have a fairly high level of confidence that they are the earnings that will be forthcoming. Except for perhaps a recession or something quite left of field, you certainly can't contemplate super spiking earnings. You may be able to contemplate um, uh, situations of distress in the Australian economy that might negatively impact their earnings. But the message is, being so well understood, being so mature, the forecasts out there look very reasonable. So it's very difficult, therefore, to reconcile why it is this calendar year the market cap of CBA has increased an astonishing $77 billion to now take it to a multiple of 26 times, which is a 60-odd percent, 65% premium to domestic banks and a full 100% premium to where international peers trade. Why has this happened? Well, the message would be it hasn't happened on the basis of fundamentals. It's happened for different reasons. Much as stocks like to anchor to earnings over the long term, in the meantime, whether it's sentiment or liquidity, and I did show you that Bitcoin chart before, those factors can have significant influence on share prices. The last thing I want to communicate is that CBA is Bitcoin. Instead, I'd like to communicate CBA is a high-profile name that has benefited a lot from that amount of liquidity and sentiment that's having impact on share prices at the moment. So where does that take us to? The last couple of slides, and then I'll finish. With what has been performance from markets over and above earnings delivery, we now sit with elevated valuations. Okay, and what I've shown on the left there is just, again, the ASX 200 with the in the light blue against the US. In both instances, you can see both markets are at multiples that are above their historical average. And I would argue it's actually less justified, it seems, in Australia, to the extent that we are not really making much progress on the earnings front relative to the US. It's also worth noting that a curiosity this year, if you think back to the narrative and the discussion at the start of this calendar year, there was a lot of focus on policy rates, a lot of focus on what the shape of policy easing would look like and whether we're going to have a soft landing or a no landing or a hard landing. That's quite absent now from the sort of discussions and commentary that's going on. Much more we are hearing about other drivers, but the point of this is just to say that it is quite interesting that we've had such a strong re-rating, if you like, of equity markets to now very elevated multiples versus history, despite the fact that 10-year government bonds have sort of hung around at relatively elevated levels. And that's why I've put the chart in on the right-hand side, just to show the way that equities look particularly expensive relative to bonds when you plot the equity yield of each market less the 10-year government bond yield. It's somewhere we haven't been now for about 20 years. So the way we then summarize the outlook and bringing it just back to Australian equities, which is our main focus, overall our stance is a conservative one as we sort of think about the outlook from here and what plays out in 2025. And it's just simply, again, wanting to reinforce that prices have run ahead of fundamentals. What that means for 2025 as a year of performance, we may well have a return to normal with a mid to high single digit type return from the ASX. That certainly can't be ruled out. But what we would want to stress is that because yield is quite depressed and because earnings, as shown in the bottom right chart there, is in somewhat of a sideways pattern, it does elevate the hurdle. It does make for a challenge for the market in the coming 2025 calendar year. What that means for investors, and certainly the way that flows through into how we invest, and I will talk about this in the early in the new year when I reflect on our performance and our positioning and what we're thinking about for 2025. The key comment to make is that we think now couldn't be a more important time to be positioning differently to the market and to be selective about what sort of companies you're invested in. So I'll stop there and end the presentation. Thank you for your time and wishing you all the best over the festive season, and look forward to returning in early 2025.